Hi, this is Hari Prasad. In this video, we will solve a problem from partnership accounts. Let's see the problem. A and B are partners sharing profit and losses in the proportion of 3 by 4 and 1 by 4 as at 31st March. The first point I am going to give to student is underline the important points in the questions using pencil during the exams. A and B are partners. 3 by 4 and 1 by 4 are the profit and loss ratio. They have given the balance sheet as at 31st March 2021. A's capital is 2,85,000. B's capital is 1,55,000. Creditors 3,75,000. General reserve 60,000. Cash in hand 1,15,000. Cash at bank 1,10,000. Sundry debtors 1,60,000. Stock 2 lakh. Bills receivable 30,000. Land and building 2,15,000. Office furniture 10,000. They agreed to take C into partnership on 1st April 2021. C new partner from 1st April. Goodwill is to be valued at rupees 2 lakh. Goodwill is 2 lakh. C is unable to bring cash for his share of goodwill. Okay, C is not able to bring cash for his share of goodwill. So it was decided that due credit for goodwill be given to A and B for their sacrifice in favor of C to C's current account. Next point. C pays rupees 1,40,000 as his capital for 1/5 share in future profit. C pays 1,40,000 as his capital. That is, C's capital is 1,40,000. And they have also given C's profit sharing ratio, which is 1 by 5. Okay. Next point. Stock and furniture to be reduced by 10%. We have to reduce the stock and furniture by 10%. First, we need to find what is 10% of stock and furniture and decrease that amount from the stock account and furniture account. Next, a provision at 5% for doubtful debts to be created on debtors. Land and building to be appreciated by 20%. Like stock and furniture, we have to find what is the 20% of land and building and add it. Here we need to add the 20% amount. The capital accounts of partnership be readjusted on the basis of the profit sharing arrangement, and any excess or deficiency is to be transferred to their current accounts. That is, their capital account balance should be in their profit sharing ratio. Any amount excess of the ratio should be transferred to current account. We have to prepare revaluation account and partners capital account. What student need to give in their answer sheet is revaluation account and partners capital account. But before preparing revaluation account and partners capital account, we have to work various things. Okay. First point is finding the new profit sharing ratio. Calculation of new profit sharing ratio. Let's see how to find the new profit sharing ratio. A's ratio is A's old ratio is 3/4. But the new ratio, the new profit sharing ratio for A is not given. We have to find that now. But they have given the new ratio for C. What is the new ratio? New profit sharing ratio. New profit ratio for C is 1/5. That is, if the profit of the firm is 5 rupees, C will get 1 rupees. That is the concept behind this new profit sharing ratio. From that example, if the firm's profit is 5 rupees, C gets 1 rupee. Balance is 4 rupees, right? This 4 rupees is shared between A and B. Now what we can do is how to find the profit sharing, new profit sharing ratio of A. Take the old profit sharing ratio of A, which is 3/4, which is 3/4 into what I call as remaining ratio. What is the remaining ratio? The remaining ratio is 4/5. How I got 4/5? If the firm's profit is 5 rupees, 1 rupees goes to C. Okay. What is the balance amount? 4 rupees is available for A and B. That is the 4-year. The total profit is 5. Multiply this. 12/20. Now what you need to do is simplify it. The number which divides 12 and 20. 12 is divided by 2. 20 is also divided by 2. Okay. 12 divided by 2 is 6. 20 divided by 2 is 10. Again, 6 is divided by 2, 10 is also divided by 2. Let's divide again. 3/5. This is the new profit sharing ratio of A. In the same way, let's find out the new profit sharing ratio of B. What is the old profit sharing ratio of B? Old ratio of B is 1/4 into what is the remaining ratio? 4/5. The answer here is 4 into 1, 4 divided by 20. Now again we need to simplify it. 4 is also divided by 2, 20 is also divided by 2, 2s are 4. 20 divided by 2, 10. Again, 2 is, we can divide 2 by 2 is 1. 10 divided by 2 is 5. The new profit sharing ratio of B is 1 by 5. What is the new profit sharing ratio of C? 1 by 5. A's ratio is 3 by 5. B's ratio is 1 by 5. C's ratio is 1 by 5. All the denominator of the ratio is 5. Let's remove it. The new profit sharing ratio is 3 is to 1 is to 1. The first step in the question is to find the new profit sharing ratio, and we have found it. 3 is to 1 is to 1. Next is we need to find the next what we need to do is calculate sacrificing ratio. What is sacrificing ratio? Sacrificing ratio is some partners are giving up their profit share to the another partner. Who are the partners give up their profit and who is gaining? Let's see. A's new ratio is 3 by 5. B's ratio is 1 by 5. C's ratio is 1 by 5. How we can find sacrificing or gaining ratio? Sacrifice or gaining ratio is new ratio minus old ratio. Let's see. A's new ratio is 3 by 5. Old ratio is 3 by 4. Multiply this. 5 into 4 is 20. To subtract fractions. First step is multiply the denominator. 5 into 4, 20. Next is multiply the numerator 1 into denominator 2. Okay. What is 3 into 4? 12. Minus. Next, multiply numerator 2 into denominator 1. 5 3, 5 into 3, 15. Now 12 minus 15 is minus 3 by 20. This is the ratio. Now we are getting ratio in minus 3 by 20. That is, this implies A is sacrificing. Now let's find B is sacrificing or gaining ratio. Let's find whether B is sacrificing or gaining. Same. What is the new ratio of B? 1 by 5. Minus the old ratio of B is 1 by 4. How to subtract fractions? The same thing what we have done with A. Multiplying the denominator. 5 into 4, 20. Now, multiply numerator 1 into denominator 2. 1 into 4, 4. put that 4 in numerator, minus numerator 2 into denominator 2. 1 into 5, 5. Minus 1 by 20. Again, what we are getting for B is minus 1 by 20, which implies again B is sacrificing. You can see from the workings. Minus 3 by 20 is A's sacrifice. Minus 1 by 20 is B's sacrifice. Let's find out what is the sacrificing or gaining ratio of C. The new ratio of C is 1 by 5. Old ratio is 0, right? He is the new partner. He does not have old ratio, which means the total 1 by 5 is gain for C. First step, finding the new profit sharing ratio done. Second step, calculation of sacrificing or gaining ratio done. Next step here is what will be the adjustment for the goodwill. We know the total goodwill is 2 lakh. The total 2 lakh rupees of goodwill belongs to A and B. But as we have found out in the gaining ratio, C gains 1 by 5th of this goodwill. What is 1 by 5th? 2 lakh multiplied by 1 divided by 5, which is 40,000. C is gaining 40,000 rupees in goodwill from the firm. And what is the sacrifice of A and B in this goodwill? A's sacrifice of goodwill. A's sacrifice of goodwill is 2 lakh into minus 3 by 20. What is 2 lakh multiplied by minus 3 divided by 20? 30,000. That is, A is using 30,000 of goodwill to C. And what is B's sacrifice? B's sacrifice is total goodwill into sacrificing ratio, minus 1 by 20, which is 10,000. Again, B is losing or sacrificing 10,000 of goodwill to C. Now what we need to do is, we have to make a journal entry so that A and B do not lose the goodwill and C do not gain the goodwill, because this goodwill belongs to A and B. This goodwill is created by A and B in the past, but now after becoming partner in the firm, C will get a share of this goodwill, which he is not entitled to get. Thus, what we are doing is, we are debiting the C's capital or current account. Partner's capital or a partner's current account is debited. It implies that the partner's capital account is reduced. We have found the A is sacrificing goodwill, B is sacrificing goodwill, and C gaining goodwill. Journal entry for the goodwill is gaining partner account debit to sacrificing partner account credited the respective amounts. In the question, it was decided due credit for the goodwill be given to A and B for their sacrifice in favor of C through C's current account. Who is the gaining partner here? C. Instead of gaining partner capital account, that is C capital account, we have to use current account. C is current account. That is the journal entry here. C. C is current account debit 40,000. 40,000 is the amount C is gaining from the goodwill to sacrificing partners capital account. A is sacrificing 30,000 credited. B is sacrificing 10,000 credited. Let's see the revaluation account. What is revaluation account? Revaluation account, when the assets and liabilities of the firm is revalued, their value is changed. It might be increased or decreased, but if their value is changed, we have to draw a revaluation. Now, what is the concept of this revaluation account? We have to find the profit from revaluation. We have to debit all the losses in revaluation. If we are losing the value due to revaluation, we have to debit the revaluation. If there is a profit or gain due to revaluation, we have to credit the revaluation account. Revaluation account, particulars amount in the debit side, particulars amount in the credit side. Let's see what are the assets that is revalued. Stock and furniture to be reduced by 10%. Here, the asset, stock and furniture is reduced by 10%. What is the stock value? 2 lakh. That is 2 lakh into 10%. What is 10%? 10 by 100. The meaning of 10% is 10 divided by 100. The answer is 20,000. That is, we have to reduce the stock value by 20,000. If the asset value is decreased, that is the loss for the firm. If you are buying an asset and the asset value is decreased, that is the loss. If the value of the asset is increased, it's profit. The firm is incurring loss of rupees 20,000 due to reduction in the value of stock. The concept of revaluation account is loss is debited. See, stock revaluation account is debited by 20,000 due to reduction in stock value. Furniture account is also reduced by 10%. What is the value of furniture? Office furniture value is 10,000. 10,000 multiplied by 10 by 100 equals 1,000. Furniture value is reduced by 1,000, which is loss. Again, revaluation account is debited by 1,000. A provision at 5% for doubtful debts to be created. Now, we are creating a provision. We are not changing the existing assets or liability, but we are creating a new liability in the name of provision for doubtful debts on debtors. Creating a liability is a loss, right? What is the value? 5% on debtors. What is the value of debtor here? 1,60,000. 1,60,000 into 5%. 1,60,000 into 5% is 8,000. 8,000 is loss. Again, we have to debit the revaluation account. Revaluation account is debited by 8,000 in the name of provision for doubtful debts. Land and building to be appreciated by 20%. If the asset value increases, it is a profit. Then we have to credit the revaluation account. What is the amount? Land and building is 2,50,000 into 20 by 100, which equals 50,000. In revaluation account is debited by 50,000 by land and building. Now we have to balance the account. We have 50,000 total in credit side. What is the total? The debit side, 29,000, which means the balancing figure is 21,000. Revaluation account represents profit or loss when a revaluation is done. Here 21,000 profit. This profit belongs to A and B in their old profit sharing ratio, not new ratio, because this revaluation is done before C is admitted as partner. What is the A share from this profit? 21,000 into 3 by 4. 3 by 4 is A's old ratio, 15,750. B's share 21,000 into 1 by 4, 5,250. Revaluation account done. Next, partners capital account. The opening balance of A's capital is 2,85,000. B's capital is 1,55,000. Before admitting a new partner, all the reserves in the balance sheet should be transferred to old partner. All the reserves in the balance sheet should be transferred to old partners in their profit sharing ratio. 60,000 into A. What is A's old ratio? 3 by 4, which is 45,000 transferred. What is B's share of ratio? 60,000 into 1 by 4, 15,000 transferred. Reserve is the profit, right? Profit should always be credited to the capital account. We are crediting 45,000 for A, 15,000 for B. Next is the profit from revaluation account. What we found out? 15,750. Again, as I said, profit should always be credited to capital account. 15,750 credited, 5,250 credited. From the question given, we can find out C is bringing in 1,40,000 as capital in cash and by bank account. C's capital is credited because he is bringing that as capital. 1,40,000 C's capital is credited by bank account. Next, we have to post the goodwill sacrificing and gaining inventory. C is current account, not capital account. Current account is debited by 40,000. Okay. A's capital account is credited by 30,000. B's capital account is credited by 10,000. A's capital account is credited by 30,000. B's capital is credited by 10,000. In the question, they have not asked for partner's current account. What is the next step? The capital accounts of the partners to be readjusted on the basis of the profit sharing arrangement. What is profit sharing arrangement? What is the new profit sharing ratio? 3:1:1. A, B, C. These three partners' capital account balance should be in ratio of 3:1:1. That is, the first point is C's capital and B's capital should be equal. 1:1. What is C's capital? 1,40,000. Which means B's capital should also be 1,40,000. Let's find the balancing figure of B's capital account before adjustment. 1,50,000 plus 15,000 plus 5250 plus 10,000, which is 1,85,250. But B's capital account should be 1,40,000 because B's capital account should be equal to C's capital account. Then what is the excess amount? 45,250. This excess amount should be transferred to B's current account. That's the point they are telling here. Readjusted on the basis of the profit sharing arrangement. Any excess or deficiency is to be transferred to the current account. Here B is having excess capital. So that amount 45,250 is transferred from capital account to current account. We are transferring it here. If any partner's account should be reduced, then that partner's account need to be debited. Here we have to reduce the B's capital from 1,85,250 to 1,40,000. We are reducing by debiting it, the 45,250. Again, by this ratio, what we are getting is A's capital account should be 3 times of B and C capital. What is B and C capital here? 1,40,000. What is 3 times multiplied by 3? 4,20,000 should be the A's capital. Let's find the balancing figure of A's capital before adjustment. $2,85,000 plus 45,000 plus 15,750 plus 30,000. The balancing figure of A's capital account is 3,75,750. But the A's capital should be 4,20,000. We need to increase it. We have to increase the A's capital by 44,250. Again, if the capital account need to be increased, it should be credited. Now we are crediting it. 44,250. Now it's in the ratio 3:1:1. In this capital account, This balance carry forward is not the balancing figure. We have found this by using the profit sharing ratio. What is the balancing figure? This amount, this amount. That's the end of the sum. We can meet in next video.